budgeting, saving, and building an emergency fund. Budgeting is you creating a plan for your money, instructing your money on what you want it to do for you, and not just having a mind of its own and ending up whichever way it would want to go. It is making sure that you not only have enough to spend to cover all of your expenses, but being able to save and invest for your future financial goals. What are some of the benefits of doing this? Number one, it gives you control over your finances. You make the decision, not the money deciding for itself. Number two, goals achievement. It helps you achieve the goal that you have actually set out on paper, such as building a house, paying for college, saving for retirement, and so on and so forth. The third is debt repayment. You'll be able to manage your debt and allocate it towards debt repayment, focusing on the ones that have high interest first so they don't erode your wealth. And lastly, it gives you so much peace of mind, which reduces your financial stress and uncertainty of the future. So how do we go about creating a budget? There's so much that goes on when it comes to creating a budget, but it doesn't have to be complex. The first thing you want to do is categorize all of your spendings. Put them into 4 major buckets. The first is the fixed expenses, which includes your rent, your mortgage, your car payment, daycare, spendings that have a fixed amount every month and must be paid. This should not exceed 60% of your take home. And the lesser it is, the better, preferably around 40%, because that gives you more disposable income towards other things that matters to you the most. The next bucket we're talking about is net worth building / debt repayment. This includes your savings, your investments, repayment of debts. The minimum allocation you would want to put towards this should be 20%. The more, the better. And the third is discretionary expenses. Those are expenses that covers your groceries, your personal care, taking care of your pets, and so on. You should allocate about 20% to this bucket. And it's called discretionary because the cost varies from month to month. If you spend $500 on food this month, next month it could be $600, and the month after it could drop to $400. So they are not fixed, or provision for them needs to be made. And the last bucket, which is my favorite, is fun spending. Who doesn't love fun? All work and no play is not what life is meant for. And this category includes your dining out, your entertainment, and travels. The allocation towards this could be about 20% as well. Those percentages are guidelines, sure that all the areas that matter to us are well covered, not leaving one underfunded and the other overly funded. After categorizing your expenses, you want to track them. You want to measure how well you are on track. So you record every spending that you make as much as you can to see what your spending pattern is like. Then the third is adjusting your spending. Having seen what your spending pattern is like, it's time to analyze it and see where you could be over allocating and where you could be under allocating. Decide on some areas where you can cut down to make room for other buckets that have less allocation. At different points of life, we need to make sacrifices. So if you would dine out less or travel less or buy clothes less, just to save for your tomorrow, it's well worth it. Cancel some subscriptions that don't mean so much to you to be able to save up and have some money to invest. And number 4 on the budgeting is to review and adjust your budget regularly. Budgeting is not just a one-time activity. The purpose of it is to be able to put your expenses on paper, your income on paper, and how to reach your financial goals with those expenses and income. As time changes, your goals changes, your income changes, so you need to review them and keep them aligned. So moving on to saving, it's essential to save to achieve financial stability and security. It helps you build a soft landing, well prepared for financial emergencies, and you can take advantage of opportunities when they come your way. We can divide savings into 4 parts. Number 1 is short-term savings. Those are to fund the goals that you have within a year. And those kind of savings should be put in the high interest savings account to maximize returns, or in the money market. Those are checking accounts that you have access to but have high interest rates. And you can put those kind of savings in guaranteed investment certificates, also called GICs, or in short-term bonds. And then you have your long-term savings to help you achieve any goals over 5 years. This could include home ownership, saving for education, saving for retirement, and so on. For this category of savings, consider investing. It is highly encouraged for you to invest your money to help speed up the wealth accumulation. First and foremost, you'll want to take advantage of the registered account so you can maximize your returns and save on paying taxes. And those include registered retirement savings plan, RRSP, tax-free savings account, TFSA, registered education savings plan, RESP, some life insurance products that have cash value for their great tax advantages, and registered disability savings plan, RDSP, for those that have access to it. If you're saving towards a house, I would highly encourage you to consider saving in the First Home Savings Account, FHSA, to help boost your savings for home ownership faster. And the fourth under savings is emergency funds, which becomes your safety net for unexpected costs and expenses, like your car breaking down and you need to pay out of pocket, or some repairs around the house that you didn't include in your budget. You want to make sure your emergency funds are highly liquid, and by that I mean it's very easy to access the cash. So I would encourage you put those as well in the high interest savings account, ISA, with banks that have the highest interest rates, or financial institutions that have the highest interest rates. You could also consider the money market accounts. Those are accounts that you can write check for, but their interest rate is also high. And the last we'll talk about is building an emergency fund. Having an emergency fund is vital and cannot be underestimated because it saves you from financial setback and getting into debt, having a negative impact on your finances. So what are the steps to building an emergency fund? Number one, set an amount. How much exactly would you need for emergency funds? It's generally encouraged for you to have about 3 to 6 months of your monthly expenses as your emergency fund. Having 3 to 6 months of monthly expenses as emergency funds can be overwhelming for some people. Starting with about $500 or $1,000 is a step in the right direction. And then, as you get better on your habit of savings and spending, you can gradually increase it. But having that habit is the most important thing. The next step is you want to keep it separate. You don't want to mix it up with other savings that you may have. This would reduce the temptation of you wanting to spend out of it. Keep it aside and take your mind off it. Doesn't even exist. And the last step is replenish your emergency funds as the need arises. If and when the need to spend from your emergency funds arise, make it a point of duty to replenish it as soon as possible. Try to save it back to that 3 or 6 months or whatever the initial amount was before you used it up. And you may wonder, how does budgeting, savings, and emergency fund help in the investment journey? They are all vital for financial security and wealth building. Effectively putting all this in place helps you to have a robust savings for today and for tomorrow. And it is a solid foundation for long-term financial success. It's not only enough for you to know these things and not do them. Momentum comes with action. Begin to take steps today for your financial security. I remain Omo, the money coach. Keep being smart with your money.